Welcome to This Explainer. Today, we're tracing a pretty wild trajectory. We're looking at how digital assets are shifting from their, notoriously shady dark web origins straight into the very foundation of tomorrow's banking infrastructure.
Let's just kick things off with a number that's honestly kind of hard to wrap your head around. $33 trillion. By 2025, that is the astonishing transaction volume stablecoins were processing globally. To really put that into perspective, that single year of stablecoin volume completely dwarfed the combined processing volume of traditional giants like Visa and MasterCard. They sat at around 24 trillion combined. Just think about that scale for a second. We're talking about decentralized networks handling more volume than the rails powering basically every credit card sitting in your wallet right now. Absolutely wild.
So with the total crypto market cap surging past $3.5 trillion, and the recent passage of the Genius Act setting up a federal regulatory framework for stablecoins in the US, we've got to ask a massive question. Is this technology still just a haven for cybercriminals in a shadow economy, or is it actually the foundational infrastructure of tomorrow's traditional banking?
All right, Act 1, the myth and the dark side. Let's get right into it. Look, if you've followed the news over the past decade, you know the headlines. And we have to acknowledge that the public skepticism surrounding digital assets is completely valid. It's rooted in some highly publicized cases. Take the infamous Silk Road dark web marketplace, where authorities eventually seized 144,000 Bitcoin. And yeah, the founder of that platform was recently granted a presidential pardon. Then you've got state-sponsored actors like North Korea's Lazarus Group exploiting the ecosystem for billion-dollar heists. I mean, the $620 million Ronin hack, the KuCoin breach, and that staggering $1.5 billion Bybit hack. When you hear about sums like that just vanishing into the ether, it's pretty easy to see why the shadow economy narrative took such a firm hold.
But you might be wondering, how do these malicious actors actually move such massive sums without getting caught on day one? Well, criminals often try to obscure their funds using automated privacy protocols known as mixers. Tornado Cash is a prime example here. The process basically runs in 3 steps. First, illicit funds are deposited into a smart contract. Second, they get mixed up in a massive shared liquidity pool with a bunch of funds from other users. And third, they're withdrawn to a completely new wallet address. The whole goal is to sever that cryptographic link between sender and receiver, creating this dense digital fog that makes tracking, incredibly difficult.
Which brings us to Act 2, the reality of traceability. And here is where the narrative shifts dramatically. Because the idea of blockchain being this completely anonymous black box, it's actually a massive myth. Blockchain networks are what we call pseudonymous. This means that while your actual real-world name isn't directly slapped on your account, every single transaction you make is permanently recorded on a public immutable ledger. Participants are identified by a public key or wallet address, and those identifiers permanently link your transactions to a highly traceable, unerasable history. Anyone, anywhere, can pull up the ledger and follow the breadcrumbs.
Honestly, this brilliant transparency has sparked an entirely new, booming industry. RegTech, or regulatory technology. Firms like Chainalysis, TRM Labs, and Elliptic have built massive businesses doing blockchain forensics. They take these public, on-chain patterns and mash them up with off-chain, real-world intelligence to map out illicit flows that criminals mistakenly thought were hidden forever. They're essentially acting as the digital detectives of the modern era, decoding the flow of money in real time.
But here's where the net truly closes on bad actors. Even if you move funds around the blockchain endlessly, eventually you're going to want to spend that money in the real world, right? To buy a house, a car, whatever. When these pseudonymous users attempt to convert their assets into traditional fiat currencies, they have to go through regulated entities known as virtual asset service providers, or VASPs. Think of centralized exchanges. These platforms act as strict gatekeepers enforcing rigorous know-your-customer rules, which completely strips away the pseudonymity and exposes the real-world identities holding those wallets. It's the ultimate bottleneck where digital anonymity hits a brick wall of traditional financial scrutiny.
All right, moving into Act 3, the institutional shift.
Because this underlying blockchain infrastructure has proven itself to be highly secure, incredibly efficient, and as we just saw, deeply traceable, traditional finance is moving in, and they are moving in fast. We are witnessing a fundamental shift in how money moves globally. In legacy systems, a transaction might take 2 days to fully settle and clear, what the industry calls T+2. Imagine waiting days for a wire to cross borders. But by using programmable stablecoins, that settlement time shrinks from days to near real time, or T+0. Instant, automated 24/7 clearing. This unlocks entirely new levels of global liquidity.
The strategic advisory firm Horn & Company hit the nail on the head in their research. They noted that anyone who still considers this a niche crypto topic is missing the biggest shift in payment infrastructure since SEPA, the Single Euro Payments Area. This isn't just a software upgrade, it's a complete reimagining of the financial plumbing that runs the world. Think about moving millions of dollars on a Sunday, across oceans, in a matter of seconds, for literally fractions of a penny. Total game changer.
And hey, this isn't just theoretical future talk either. We're seeing incredible operational value creation today. Take NRW Bank, for example. They successfully issued a 100 million euro tokenized bond entirely on the Polygon blockchain. By using this tech for a delivery versus payment transaction, they completely eliminated counterparty risk. That means no one is left waiting around hoping the other side actually pays up. The delivery of the bond and the payment settled simultaneously in a single atomic transaction on-chain. Perfectly trustless execution.
So there's this major misconception out there that traditional banks are fighting the blockchain. Actually, scratch that. They aren't fighting it at all. They are rapidly adapting their business models to serve crucial roles in this new ecosystem. They're positioning themselves to act as secure custodians for tokenized assets, they're serving as the critical on- and off-ramps bridging fiat and crypto, and they're stepping up as liquidity providers to ensure these 24/7 global markets run smoothly. They see the writing on the wall, and they absolutely want to be the ones managing the ledger.
Plus, these massive institutions realize they can't just build this global infrastructure in isolation. Trust, liquidity, regulatory compliance, they all require powerful networks. This realization has led 9 major European banks, including heavyweights like Raiffeisen, UniCredit, and ING, to form a unique consortium. Together, they're collaborating to issue a fully compliant euro-based stablecoin under Europe's strict MiCA regulations. This is exactly what it looks like when traditional finance leverages decentralized tech, fully by the book. Finally, let's wrap this up with our resolution, the gatekeepers of tomorrow.
For this programmable shift to work safely on a global scale, the rules of the road just have to be unified. Academic consensus and legal research strongly highlight that a globally coordinated anti-money laundering, or AML framework, is absolutely essential here. We've got to balance the vital need for financial security with the incredible potential of decentralized innovation. We can't stifle the technology that brings us T+0 settlement, right? But we definitely must protect the global financial system by focusing intelligent regulatory oversight on those key gatekeepers we talked about earlier.
So, as digital assets rapidly transition from the notorious fringes of the dark web right to the core of global finance, and as programmable money literally rewrites the rules of settlement, trust, and speed, it leaves us with one critical question. Is your bank ready for the programmable future?